Warren Buffett is one of the most successful investors of all time and a staunch proponent of value investing. He built his fortune by focusing on a simple truth. The market price of an asset isn't always the same as its real value. In Buffett's view, understanding the difference between price and value is the cornerstone of smart investing. We explore 7 of his famous quotes that illuminate this concept, each offering a lesson on how to think about what something is worth versus what you pay, and how that philosophy leads to long-term success. We'll also conclude with a brief summary of these insights. Price is what you pay, value is what you get. Buffett's most famous adage highlights a fundamental difference between price and value. The price of a stock is simply its cost in the market, a number often driven by supply, demand, and investor emotion. The value, however, is what the underlying business is actually worth, based on its assets, earnings, and future prospects. According to Forbes, price is arbitrary and value is fundamental. For investors, Buffett's quote is a reminder not to confuse market price with intrinsic value. A savvy investor looks beyond the sticker price and analyzes the business, its products, competitive advantages, management, and financial health. Sometimes the market significantly misprices a stock, panicking in a downturn and driving the price well below a company's true value, or becoming overly euphoric and bidding the price far above what the business is really worth. Buffett has repeatedly capitalized on this by buying quality companies when their prices dip below their true value. By focusing on what you get for your money, rather than just the number on the ticker, you ground your decisions in reality, not market mood swings. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This quote speaks to the importance of quality over sheer cheapness. In his early career, Buffett often hunted for ultra-cheap stocks, what he called cigar butts, mediocre or struggling companies trading at bargain prices. But his business partner, Charlie Munger, convinced him in the 1960s to flip the formula. Instead of buying fair businesses at wonderful, very low prices, start buying wonderful businesses at fair prices. In other words, it's worth paying a reasonable price for a great company, rather than buying a so-so company just because it's dirt cheap. A wonderful company, in Buffett's terms, is one with durable competitive advantages, a solid business model, and consistent earnings. Such a company will grow in value over time, even if you pay a bit more upfront, a fair price, not necessarily a rock-bottom steal. The quality of the business means it can deliver strong returns for years to come. On the other hand, a fair, average company bought at a wonderful, extremely low price might look good initially, but if the business doesn't perform well, its value won't increase much. Buffett's approach, reflected in this quote, is to seek out excellent companies, those with reliable profits and strong franchises, and purchase them when they are reasonably priced relative to their true value. This philosophy was a pivotal shift in Buffett's strategy, and is one reason Berkshire Hathaway's investments, like Coca-Cola or Apple, have been so successful. Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. Here, Buffett draws a charming parallel between everyday shopping and investing. Most people love a good sale when buying things like clothing. If your favorite high-quality brand of socks goes on sale, that's great news. Buffett applies the same thinking to stocks. He loves buying shares of great companies when their prices are marked down. In essence, a market downturn or a dip in a quality stock's price is like a clearance sale at your favorite store. The key word in this quote is quality. Buffett isn't interested in buying something just because it's cheap. He wants quality merchandise on sale. This means he looks for robust companies whose stock prices have fallen due to temporary factors or market overreaction. For example, during broad market slumps or recessions, even solid companies can see their stock prices drop dramatically as investors indiscriminately sell. Buffett famously views those moments as times to be greedy while others are fearful. His socks or stocks quote encourages us to keep a shopping mentality. If you know the true value of a company is high, a lower price is good news. Patience and a keen eye for value will reward you because eventually the market recognizes a quality company's worth, and by then, you'll be glad you bought at a discount. Beware the investment activity that produces applause. The great moves are usually greeted by yawns. This colorful warning reminds investors that flashy moves aren't always smart moves. If an investment or strategy draws excited applause and hype, Buffett suggests wariness. In his view, boring is good when it comes to investing, because solid, profitable businesses like utilities, insurance, or consumer staples might not capture headlines or public fascination, but they quietly churn out reliable returns year after year. In contrast, chasing the hottest new trend or glamorous stock, the kind that gets everyone clapping, can be risky or fleeting. The quote advises us to be skeptical of investment fads that everyone is cheering on. For example, speculative IPOs, meme stocks, or any strategy dubbed the next big thing. A great investment might seem dull. There's no standing ovation when you quietly buy a well-run company's stock and hold it for a decade. But the results of that patience and prudence can be extraordinary. The best investments are judged by their outcomes, not the applause on day one. It's not necessary to do extraordinary things to get extraordinary results. This quote reflects Buffett's humble assertion that investing success doesn't require superhuman feats. Despite his own extraordinary results over the decades, he frequently emphasizes that what he does is not magic, it's common sense and discipline. You don't need to find the next unicorn startup before anyone else, time the markets with precision, or devise a never-before-seen trading strategy. Instead, sticking to basic principles, like thoroughly researching businesses, investing within your circle of competence, maintaining a long-term horizon, and not overpaying, can yield outstanding outcomes over time. Buffett's own strategy is a perfect example of this philosophy. He famously says he just tries to be consistent, not clever. The magic ingredient is patience. Thanks to the power of compounding, even average annual returns can snowball into huge wealth given enough years. So, focus on the fundamentals and avoid reckless moves, and over the long run, you too can achieve something remarkable. Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. In investing, truly golden opportunities, where an asset is dramatically undervalued or a market crash presents once-in-a-decade bargains, do not happen every day. Buffett uses this vivid metaphor to advise that when such an opportunity does appear, take full advantage of it. Don't show up with a tiny thimble, bring a big bucket. In practical terms, this means when you strongly believe a situation offers outsized potential, and you've done your homework to be confident in that belief, you should invest meaningfully, not timidly. Buffett has demonstrated this principle throughout his career. For example, during the financial crisis of 2008 to 2009, while many investors were fearful, he made bold investments in companies like Goldman Sachs and General Electric on favorable terms, effectively putting out a bucket when others were scared. The underlying message is to be prepared and decisive when rare opportunities arise. Most of the time, investing is relatively uneventful and patience is key. But when it rains gold, say a market crash where even strong companies are ridiculously cheap, Buffett counsels against hesitation or half measures. Such moments are rare, but that's exactly why capitalizing on them is so powerful. The dumbest reason to buy a stock is because it's going up. This blunt warning targets one of the most common investor mistakes, buying into a stock simply due to its upward price momentum. In exuberant markets, people often pile into whatever is skyrocketing. Tech stocks in a bubble, a hot new IPO, or any stock that's on a run, without stopping to ask whether the underlying business justifies the price. Buffett calls this the dumbest reason to buy because a rising price alone tells you nothing about value. As he once observed, too many people take their cues from price action rather than from values, and that approach leads to trouble. Just because a stock has gone up doesn't guarantee it will keep going up, nor does it mean the company is truly profitable or sustainable. In fact, a rapidly rising stock can be a sign of a bubble or speculative frenzy. Chasing performance in this way is essentially betting that momentum will continue, which is not a reliable strategy. Eventually, momentum falters, and if there's no solid value underpinning the price, a steep drop can follow. Buffett urges investors to base decisions on fundamentals rather than the fact that everyone else is buying it or it just hit a new high. History is littered with examples of the folly he describes, from the dot-com boom to more recent meme stock episodes where prices detached from reality. He instead advises asking, would I still want to own this company if the market closed for 10 years? If the answer is no, then you're probably only in it for the short-term price rise. Wise investing means doing your homework and ensuring you're buying value, not just a price trend. These quotes teach us that successful investing comes from judging the true worth of an investment, independent of its market price. By focusing on quality businesses, seeking value bargains, avoiding hype, and being both patient and bold at the right times, Buffett has shown that extraordinary results are achieved through sound principles and disciplined action.